You're trying to buy the Vanguard 500 index fund. You read about it in a John Bogle book. You watch 3 American YouTubers rave about it. You're convinced this is the smartest investment decision you'll ever make. You open your European brokerage account, you search for the ticker symbol, you click buy, and the screen flashes red. Transaction denied. You try again. Denied. You call customer service, and the representative tells you that as a European resident, you are legally prohibited from purchasing that fund. You just spent 6 hours researching an investment you cannot legally own. Welcome to European investing, where following American advice doesn't just waste your time. It can cost you thousands in taxes, regulatory penalties, and lost opportunities you didn't even know existed. My name is Leo. I learned investing on Wall Street, then moved to Europe and spent 9 years figuring out what actually works here. And if you're watching this, you've probably tried to follow American investment advice and discovered that nothing translates the way you thought it would. The books don't mention European regulations. The videos don't explain currency risk. The podcasts don't cover your tax system. And that gap between American advice and European reality is costing you money right now. If you want to stop losing money to avoidable mistakes and start building wealth the way that actually works in Europe, make sure to hit that subscribe button and give this video a thumbs up if it helps you navigate the European investment landscape without setting cash on fire. Here's what I'm going to show you: 6 critical differences between investing from Europe versus investing from America. 6 places where following American advice without understanding these distinctions will result in lost profits, extra taxes, or regulatory problems you don't want. And by the end, you'll understand exactly how to adapt American investing wisdom to European reality without losing the valuable parts or falling into expensive traps. Because here's the thing American investment content never addresses. They're writing for Americans. They're operating inside American regulations. They're optimizing for American tax codes. And they assume you are too. When Graham Stephan recommends buying SPY, when Ramit Sethi tells you to open a Roth IRA, when Tony Robbins says to invest in specific American index funds, they're giving advice that works brilliantly in Connecticut or California. But you don't live in Connecticut, you live in Berlin or Madrid or Amsterdam, and the rules are completely different. What I'm about to show you next is the thing that took me years to figure out. Because the differences aren't obvious. They're hidden in regulatory frameworks, buried in tax codes, concealed in fund structures that look identical on the surface but function completely differently depending on which side of the Atlantic you're standing on. And most European investors don't discover these differences until after they've already made the expensive mistakes. Let's start with the most frustrating difference. EU regulations block American funds. Completely. You pick up Tony Robbins' book, Money Master the Game. Fantastic book. You read about diversification, about low-cost index funds, about putting your money in Vanguard's 500 index fund and letting compound interest do the work. You're inspired. You're ready. You open your European brokerage account and you search for Vanguard 500 index fund. It's not there. You search for SPY, the SPDR S&P 500 ETF trust that every American YouTuber owns. Still not there. You think maybe it's your brokerage, maybe you need a different platform, so you try another European broker. Same result, transaction blocked. Here's what happened. In 2018, the European Union implemented regulations called PRIPs and MiFID D2 that prohibit European retail investors from buying investment funds that are established in the United States. The logic was consumer protection. European regulators wanted funds sold to European investors to meet European disclosure standards, European reporting requirements, European investor protection rules. American funds don't meet those standards because they were never designed for European markets. So the EU said if you want to sell funds to Europeans, establish those funds in Europe under European regulations. Otherwise, access denied. Now, some investors think they've found a workaround. They open an account with an American brokerage like Interactive Brokers. They use a VPN, or they find some platform that doesn't enforce the rules strictly, and they buy American ETFs anyway. Clever, right? Except now you've exposed yourself to a different problem. American estate taxes. Here's how that works. If you hold more than $60,000 in American-domiciled stocks or ETFs and you pass away, the American government considers those assets subject to American estate tax. Your heirs, your family, your children, they don't get the full amount. The IRS takes a substantial cut first, potentially up to 40% depending on the total value. before the remaining money reaches your family. You spent years building wealth for your children, and a foreign government takes a massive tax chunk because you bought American funds instead of European ones. So investing directly in American index funds and ETFs, the way American YouTubers recommend, is usually a bad idea for European investors. Not because the funds are bad, the funds are excellent, but because the regulatory and tax structures make them inappropriate for your situation. Now, here's what this doesn't mean. This doesn't mean you can't invest in American stocks. This doesn't mean you can't buy the S&P 500. This doesn't mean you're locked out of American market exposure. You absolutely can invest in all of those things. You just need to buy funds that are based in Europe. Specifically, funds domiciled in Ireland or Luxembourg, which have become the primary hubs for European ETF structures. Let me show you how to find them. There's a website called justetf.com. It's the premier database for European established ETFs. You go to the site, you click on equity, which means stocks, you select USA under the country filter, and it shows you hundreds of fund options, all of them domiciled in Europe, all of them legally available to European investors, all of them giving you exposure to American stocks without the regulatory problems or estate tax risks. And it's not just American funds. You can access global funds, European funds, Latin American funds, emerging market funds, sector-specific funds, all through European domiciled structures. The website is free. The database is comprehensive, and it solves the first major problem that American investment advice completely ignores. But finding the right fund is only half the battle. Now you need to figure out where to buy it. Which brings us to difference number 2. Brokerage access and currency convenience. Let's say you found the perfect ETF, the iShares Core S&P 500 UCITS ETF USD. It's the most popular ETF in Europe. Over 70 billion euros in assets, low fees, tracks the S&P 500 perfectly. You're ready to buy. So you go to the iShares website at eshares.com. You pull up the fund information, and there's no buy button. You can't purchase it directly from iShares because an ETF is an exchange-traded fund. It trades like a stock on a stock exchange. You need an intermediary. You need an investment app or a brokerage. American YouTubers recommend Robinhood, Webull, Charles Schwab. Great platforms for Americans. But here's the problem. Most of them don't accept European investors. And even if they do accept you, all the trading happens in US dollars, which is incredibly inconvenient if you're earning euros or pounds or Swiss francs. You're constantly converting currency. You're paying conversion fees. You're dealing with exchange rate fluctuations every time you deposit money or withdraw profits. It's messy. So European investors need to focus on European-based brokerages. If you're an experienced investor who wants access to global markets, low fees, and comprehensive tools, Interactive Brokers and Saxo Bank are excellent choices. They accept European clients. They offer multi-currency accounts. They provide access to exchanges worldwide. If you want something simpler, something designed for ease of use without overwhelming features, Trade Republic and Trading 212 are great options. Clean interfaces, mobile-first design. Perfect for investors who want to buy ETFs, set up automatic investments, and not think about it constantly. But here's a critical consideration that varies by country. In some European countries, local brokerages automatically handle your tax obligations. Germany and Austria are prime examples. If you use Trade Republic or Flatex or other local German brokers, they automatically calculate your capital gains, withhold the correct tax amount, and report everything to the tax authorities. You don't have to manually track every trade, calculate gains and losses, and file complicated tax forms. The broker does it for you. If you're in one of those countries, using a local brokerage that handles taxes automatically is worth considering, even if the fees are slightly higher or the fund selection is slightly smaller. The time saved and the mistakes avoided often justify the trade-off. We're halfway through, and honestly, the best stuff is still coming, because the next 4 differences are where most European investors lose the most money without realizing it. These aren't just regulatory technicalities. These are strategic decisions that compound over decades and determine whether you retire comfortably or struggle financially. Difference number 3. Geographic diversification beyond the S&P 500. The S&P 500 is the default recommendation in American investment content. Just buy the S&P 500, it's diversified. It has 500 different companies. Those companies operate globally. You're automatically exposed to worldwide economic growth, and for American investors, that's reasonably true. Though even most American experts now recommend adding international diversification beyond just American stocks. But for European investors, buying only the S&P 500 means 100% of your savings are exposed to America, 100% exposed to American economic policy, 100% exposed to American political decisions. And in the age of Donald Trump, 100% exposed to the decisions of one very stable genius. That's a lot of concentration risk if you're not American and don't live in America. Now, maybe you're fine with that. Maybe you believe American companies will dominate the global economy for the next 30 years. Maybe you think the AI revolution will be concentrated in American tech companies and you want maximum exposure to that potential. That's a reasonable position, but it should be a conscious decision based on your risk tolerance and investment thesis, not a default choice because you followed American advice without questioning whether it applies to you. Let me show you the alternatives. Go back to justetf.com. Instead of filtering for USA equity funds, look at world or global funds. These invest across many countries, automatically giving you diversified geographic exposure. Or look at European funds. There are 377 different European equity ETFs available, or Latin American funds, or emerging market funds, or combine them. You could put 60% in a global fund, 30% in European stocks, and 10% in emerging markets. Or 50% USA, 30% Europe, 20% Asia Pacific. The combinations are endless. My recommendation? Keep your portfolio relatively simple. 2 or 3 big regional funds rather than 10 different country-specific funds. Simplicity reduces decision fatigue, makes rebalancing easier, and usually produces better long-term results than overly complicated strategies. And let me be clear, this isn't an anti-US investing argument. A substantial allocation to US stocks makes sense for many European investors. American companies are innovative. American markets are deep and liquid. The potential of the AI revolution is real and likely concentrated in American tech giants. But for European investors, global diversification often makes more sense than going all in on a single country's market, even if that country is America. But geographic diversification introduces another complexity: currency risk. Which is difference number 4. Here's how currency risk works. Let's say you buy a global ETF. That fund invests approximately 60 to 70% in the American market, a portion in Asia and other countries, and only around 10% in the Eurozone. Which means as much as 90% of your money is invested in assets denominated in currencies other than euros. If you're a UK investor, it's even more extreme. About 96% of a typical global fund is in currencies other than pounds. Now imagine this scenario. The S&P 500 stays completely flat for a year. Stock prices don't go up, they don't go down. But during that year, the US dollar weakens 10% relative to the euro. When you look at your portfolio value in euros, it shows a 10% loss. Your stocks didn't fall, but your portfolio fell because of currency movement. That's currency risk. And it's a real risk that can significantly impact European investors holding foreign assets. Now, here's the balanced perspective. Most investment experts argue that for really long-term stock investing, meaning 20 or 30 years, currency risk is not a major factor. Currencies fluctuate. Sometimes the dollar strengthens against the euro. Sometimes it weakens. Over very long periods, these fluctuations tend to average out. Plus, a weaker dollar often means stronger American exports, which can boost American company profits, which can offset the currency impact on your returns. The relationship is complex and doesn't always work against you. So if you're investing for the long term and you can handle short-term volatility, you can be completely fine leaving things as they are without worrying about currency exposure. But if currency risk concerns you, there's a solution. Currency hedged ETFs. Go to justetfs.com, scroll down to the currency hedge filter, and choose funds that are hedged to euros or pounds. These funds use financial instruments to remove the currency risk between the foreign currencies the fund invests in and your local currency. The fund still invests in American or global stocks, but currency fluctuations don't affect your returns the way they would with an unhedged fund. The trade-off? Currency hedge funds have additional costs. The hedging process isn't free. The fund pays for derivative contracts that offset currency movements, and those costs reduce your returns. There are also some additional risks related to how the hedging is implemented and what happens during extreme currency moves. I'm not going to tell you whether you should use currency hedged funds or not. That depends on your personal risk tolerance, your investment timeline, and your specific situation. But as a European investor, you should at least be aware that currency risk exists, that it affects your portfolio differently than it affects American investors, and that you have options to manage it if you choose to. Now let me tie all of this together, because when you see how these pieces connect, everything changes. We've covered how to find European funds, where to buy them, why geographic diversification matters more for Europeans, and how currency risk impacts your returns. But there's one more difference that creates a rare opportunity. An advantage European investors have over Americans that American videos and books never mention because Americans don't have access to it. Difference number 5. Accumulating ETFs and their tax advantage. In America, when an ETF receives dividends from the companies it owns, those dividends get paid out to the investor. American tax law essentially requires this distribution structure. So every quarter, American investors receive dividend payments in their brokerage accounts, and they owe taxes on those dividends that year, even if they immediately reinvest them. In Europe, you have a different option. Accumulating ETFs. When an accumulating ETF receives dividends, it doesn't pay them out to you. Instead, the fund uses that dividend money to automatically buy more stocks within the fund. The beautiful part? In most European countries, if you don't receive the dividends in your account as cash, you don't have to pay taxes on them that year. You can delay tax payment for many years while that money stays inside the fund, growing and compounding. This is enormous. Delaying taxes means more money stays invested, which means more compound growth, which means significantly more wealth over 20 or 30 years. It's one of the best tax optimization strategies available to European investors. Now, there are exceptions. Austria, Switzerland, and the UK have tax rules where accumulating funds don't provide the same advantage. In those countries, you're often taxed on the fund's internal dividend activity, even if you don't receive cash distributions. So for investors in those places, accumulating versus distributing funds might not matter much from a tax perspective. But in most European countries, Germany, France, Spain, Italy, Netherlands, Poland, and many others, accumulating ETFs deliver better after-tax results than distributing ETFs. You should strongly consider using them. How do you identify them? Go to justetf.com. Look for the filter called Use of Profit or Distribution Policy. You'll see two options. Accumulating, which means the fund reinvests dividends internally, and distributing, which means the fund pays dividends out to you. If you filter for accumulating, you'll notice there are actually many more accumulating funds available to European investors than distributing ones. That's because they're more popular in Europe, specifically due to the better tax treatment in most countries. American investors don't have this option. For them, accumulating fund structures aren't available in the same way due to American tax regulations. So this is one area where European investors genuinely have an advantage if they know how to use it. Which brings us to the final and most important difference. European tax systems versus American tax structures. Every American investing video at some point discusses 401ks, IRAs, Roth IRAs, FIP29 plans. If you're not American, those sound like exotic diseases or indie pop band names. But they're critically important tax structures that determine what investments make sense for Americans, what accounts they should use, and what strategies optimize their tax situation. If you live in Berlin or Madrid or Warsaw, those American tax structures are completely irrelevant to you. They don't exist in your country, you can't use them. And the investment strategies designed around them don't apply to your situation. Here's the challenge. Europe has over 30 different tax systems. The best investment approach in Spain is quite different from the best approach in Portugal or the UK or Germany. I can't cover all the tax details of every European country in a single video. That would take 10 hours and bore both of us into a coma. But here's what you need to know. Tax-advantaged accounts exist in many European countries. America has the IRA, the Roth IRA, the 401k, accounts that let you invest with significant tax benefits, paying less tax than you normally would on investment growth. Many European countries have similar accounts under different names with different rules. I researched tax-advantaged investment accounts across Europe. In Germany, there's the Riester Rente and the Rerup Rente. In France, there's the PEA, the Plan d'épargne en actions, and the Assurance VA. In the UK, there's the ISA, the Individual Savings Account, and the SIPP, the Self-Invested Personal Pension. In the Netherlands, there are tax benefits through certain pension structures. In Italy, there are PIR accounts. In Spain, there are specific pension plans with tax advantages. Sweden has the Investeringssparkonto. The list goes on. If your country has one of these accounts, you should absolutely research what's available and whether you qualify. The tax savings over 20 or 30 years can be enormous. We're talking potentially tens of thousands or even hundreds of thousands of euros in extra wealth simply because you use the right account structure. And here's the thing. You will never learn about these accounts from American YouTubers or American investment books. They don't know about them. They're not relevant to American audiences, so they're not mentioned. Which means if you're only consuming American investment content, you're missing critical information that could make a massive difference to your financial future. Local European tax knowledge makes a huge difference to wealth over time, and it's knowledge you can only get from European sources, from local tax advisors, from country-specific investment communities, or from financial content created specifically for your country. Almost there. But before I wrap up, I need to show you how all of this works together. Because understanding these 6 differences individually is useful, but seeing how they interact is what actually changes your investment results. You're a European investor. You want to invest for the long term. You've been watching American investment content. You've read the books. You understand index investing, compound interest, dollar cost averaging, all the fundamentals. That knowledge is valuable. It's the foundation. But now you need to adapt it to European reality. First, you use justetf.com to find European-domiciled ETFs that give you the exposure you want. Maybe you choose a global fund for broad diversification. Maybe you split between US and European funds. Maybe you add emerging markets. You decide based on your personal risk tolerance and investment goals, but you're choosing from funds you can actually legally buy. Second, you open a brokerage account that works for European investors. If you want simplicity and your country has brokers that handle taxes automatically, you choose one of those. If you want more control and lower fees, you use Interactive Brokers or Saxo Bank. Either way, you're using a platform that accepts European clients and lets you trade in your local currency without unnecessary friction. Third, you consider geographic diversification beyond just the S&P 500. You don't blindly copy an American portfolio. You think about whether you want 100% exposure to one country or whether a global approach makes more sense for your situation. Fourth, you decide how you want to handle currency risk. Maybe you're comfortable with it and stick with standard unhedged funds. Maybe it concerns you and you choose currency hedged versions. Either way, it's a conscious decision, not something you ignore because American content doesn't mention it. Fifth, you use accumulating ETFs if you live in a country where they provide tax advantages. You're optimizing for your tax system, not the American system. And sixth, you research what tax-advantaged accounts are available in your specific country, and you use them if you qualify. You're not trying to open a Roth IRA. You're using the equivalent that actually exists where you live. That's European investing. It's not fundamentally different from American investing. The core principles are the same, but the implementation details matter enormously. And following American advice without adapting those details to European reality will cost you thousands in lost profits, unnecessary taxes, regulatory violations, and suboptimal portfolio construction. So what financial topic is keeping you up at night that you can't find straight answers on? Currency hedging strategies? Specific country tax optimization? How to evaluate European versus American tech stock exposure? Tell me in the comments. That's what this channel is for. You're not pushing that boulder uphill anymore. You're not trying to follow a map written for a different continent and wondering why nothing lines up. You've got the European-specific knowledge. You understand the regulations, the brokerages, the tax structures, the currency considerations, the fund options. You're not blindly copying American strategies. You're adapting the valuable principles to the reality of investing from Europe. 10 years from now, when you're looking at an investment portfolio that's grown substantially because you avoided expensive mistakes and optimized for your actual situation, you'll remember this was the moment you stopped treating American investment advice as gospel and started thinking like a European investor. Your future wealthier self is counting on the decisions you make right now. Make them count.